Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, here with you on May 27th of 2020. I hope all of you had a wonderful Memorial Day weekend. We're getting a little bit later start here this week because of the holiday, but nonetheless, the activity in the market and the economy remains fairly robust. And as we have been doing for these many weeks, I'm going to kind of give you just a brief market update. And there's some interesting little tidbits that we're seeing now with this recovery in the market. And then I've got some reasons to be, we'll start off with the bad news, to be pessimistic, and then come back and then talk about the things that are perhaps a little bit more optimistic in the market. And then I want to spend a little bit of time at the end of the presentation talking about small businesses and some of the observations. And this has kind of been a recurring theme because we've talked about small businesses in the context of COVID-19 and some of the issues that they've faced relative to the big companies. And we know that, Main Street is not Wall Street. And the companies that you buy on the stock exchanges are not the mom and pop cleaners and car washes and those types of things. So there continues to be a fairly strong disconnect between the Main Street environment and Wall Street, and even within Wall Street, small companies versus large companies. So why don't we go ahead and jump into it, shall we? So last week, stocks had a pretty good week, as they are now here in the post-holiday environment as well. So the S&P was up about 3.2% last week. The Dow Jones was up about 3.3%. NASDAQ, which is obviously heavily laden with technology stocks, was up about 3.4%. But we've seen a little bit more volatility from the end of April through May, even though we've had pockets of really good performance on the index. But basically through April 29th through May 22nd, the S&P 500 is up about 0.5%. But we've seen a lot of robust daily moves in either direction. And what's interesting is on the Russell 1000, which obviously is a different index, different representation, the growth index is up about 1.2% during the same time frame, whereas the Russell 1000 value is down over 21%. So just think about that for a second. Growth companies continue to outperform value, but the difference at which that outperformance is taking place is rather astounding. Now on the bond market, the 3-month yield is 0.12%, so a shade above zero. And then the 10-year yield, which at least until recently has been kind of that benchmark yield for 30-year fixed rate mortgages, is about somewhere between 0.6 and 0.7%, when it's been holding steady for some time. All-time low in the 10-year Treasury yield is about 0.5%. So what's happening with the Treasury yield being so low is it's pushing more money into stocks. It's making stocks relatively more valuable than they would otherwise be if you strictly looked at them at a price to earnings basis. It's obviously inspiring more borrowing, and it's obviously helping some riskier companies. The NASDAQ, which I'd mentioned is up 3.4% for the week, is actually up 3.9% year to date, which is fairly impressive considering that the other indices are basically down still. And like we talked about last time, there's more IPO activity, and a lot of these IPOs, initial public offerings, essentially vehicles that are coming to market and becoming publicly traded. More of these deals are companies that are raising cash to do buyouts of distressed companies. So that's a continuing theme that we're seeing here. The other thing on the Russell indices, and we talked about the Russell 1000, we're going to get a big rebalancing, and this is an annual rebalancing. The indices that are managed by Russell go through a rebalancing where it's a once a year thing. And so they rebalance within the growth indices, the value indices, and so on and so forth. And what we're going to see is a huge movement, likely from growth to value, meaning that a lot of companies that were growth-like are now going to get kicked out of the growth index and get kicked into value. A lot of industrials are obviously going to be in that boat. And that's very interesting because, like I said, growth is beating value by the widest margin since the dot-com era. And so we've seen, a huge gap between value and growth. And some people are beginning to make the claim that the gap is so strong that it's really setting the table for value to outperform at some point, or not at some point, but over a period of time over the next 10 years or so. So we know that, we've had the first quarter earnings. All of those reports are out. We know that earnings on balance were down about 14%. But we've got some changes happening, at least on the retail side for consumer discretionary. We know that that's been challenged. We know the data coming out over the next few months are still going to be down, although less bad than they were last month, that being April. We know half of the 50 retailers and supermarkets that have filed for Chapter 11 over the past 15 years have closed all their stores and are out of business for good. So we're going to continue to see a lot of upheaval in the retail industry. Interesting on the oil market. The most highly traded contract in the oil futures market is for the December delivery. And so think about the futures market. You typically see a lot of activity in the near month because that's where most of the price visibility is. But right now, it's very unusual to bet on so far in the future, but investors remain nervous about what's going on here over the near term, even though oil is up quite a bit. So we'll have to continue to monitor that, but it's a very interesting development. But kind of looking at the pessimism, not to be look at the bad side of things, but obviously, there continues to be the fear of the second wave. Tensions with China are very strong right now. In fact, that is a groundswell that's going to continue to build, especially in this election cycle, because there seems to be some strong consensus on both sides of the aisle that we need to take steps on China. And just in the last week, we saw national security laws and being imposed on Hong Kong now. So just one step in that direction. We've got a lot of the money center banks and research houses that are calling for large drops in GDP. Again, the market's just kind of more or less blown past that right now, but they're estimating anywhere between a 30 to 40% annualized rate of decline in the second quarter. Eurozone estimated to drop 45%, UK dropping over 55%, Japan 35%. And that rhetoric is kind of bleeding into a survey that the Census Bureau took at the beginning of this month. It said 47.5% of adults live in households that have lost some employment income. 37% expect to see income loss in their households over the next month. And of those who reported losing income, 15% of homeowners and 26% of renters said that they couldn't pay their mortgages or rent. What that's telling us is that again, there's a stock market that's happening over here, and then there's the real economy over here. And what this says is that, even though we can maybe extrapolate some type of a V-shaped recovery in the stock market, which has kind of played itself out, that in the real economy, that's going to look a little bit more like, I'll just call it a Nike swoosh, because we've got a lot of fear factor that's building in the consumer side, which represents over 2/3 of the economy. But then back to the market, the S&P 500 is above its 50-day moving average and just almost on top of its longer 200-day moving average. And what does that mean? Why is that significant? Research that was reprinted by Sandy Leeds over at UT said that this is just It has been stuck in this trading range for 21 days, and this is just the 30th time since 1928 that the index has stayed between the 50-day and the 200-day moving average for at least 20 days. And his work, he says, in the previous 29 times, the market has broken lower 21 of those times. So again, lending more thought to, we have volatility coming in this market. Everything, can look good one week, and then the next week we could see a little bit of dislocation there. But market breadth, just looking at it pessimistically, is really, really weak. We've got leadership in a very concentrated select number of companies. And as I've said, a fairly large percentage of the meaningful percentage of the S&P 500 movement is being driven by a core nucleus of stocks, and most of them are technology: Facebook, Amazon, Apple, so on and so forth. And what's interesting here is that let's see, the 10 largest NASDAQ stocks have added $900 billion of value this year. The other 2,600 stocks in the NASDAQ index have lost $300 billion. So the NASDAQ is up almost 4% this year, even though the average stock is down 19. So that is just a highlight right there that that we have seen, that we have a market that lacks a lot of breadth. The other thing which is really interesting is we have seen a big increase in retail investors opening accounts and doing day trading, trying to take advantage of this volatility. We've got even reports of people taking their stimulus checks to trade stocks. That there's could be a sign of excess optimism. Again, we still have that strong disconnect between what's going on Main Street, even though the data is less bad, and what's going on Wall Street here. We know, just looking at different things, we know that China's growth is slowing. We know that traditional retail, I've mentioned that, is sick. That people like Macy's first quarter sales down 45%. Kohl's down 41%, TJX, which includes TJ Maxx, down 52%, and just looking at the debt markets, and we've got more risky debt outstanding, which is something I caught this past week, that the leveraged loan market has doubled between 2008 and today. What does that mean? Just means in 2008, 9% of loans in the main U.S. loan index were rated B- or worse, and 2% were CCC, which is kind of those are junk level statuses, and obviously the C's are lower than the B's. But in January, B- made up 20%, 10 times what was in place in 2008, and CCC loans made up 6%. So, we have more risky debt that's outstanding. We've got more of what they call fallen angels, which are investment grade companies that are being downgraded to junk status. Again, another something that we are definitely going to have to monitor. But looking at things on the bright side, there's always green shoots to talk about. We know that Fed Chairman Powell is standing behind his rhetoric in a very consistent. He's been kind of that lighthouse in the storm. Just very strong statements about propping up the economy in as much as the Fed can do. But we're seeing high frequency data that's improving. And these are just a few of these things. Map requests on Apple were down 50% between mid-January and the first week of April. Now they're just down 20. Retail visits, which is being tracked by people's movements into retailers, were off by more than 50% in mid-April. Now they're down 32%. So more activity there. Home buyer demand. It's now above pre-pandemic levels. And then Uber rides had risen for 3 straight weeks. So we've seen a pickup in global fuel demand. and so we've got a lot more activity, that we're seeing in the economy as some of these economies are beginning to open up. The market is relatively comfortable with near-term bad data. Not even worth mentioning what the earnings are going to look like, because it's going to be ugly, but the market is looking ahead to 2021 and 2022. And as I kind of alluded to before, lower interest rates are boosting the current value of future earnings and making them look actually fairly attractive. But with that, I wanted to transition here in our last segment to kind of the small business mindset, the small business opportunity. And with to start off, I want to talk about the Federal Reserve again and what they're doing. They have one of their various programs that they've instituted, and so far it's been more of what they're talking about wanting to do than what they've actually done to date, and that's their Main Street lending program, and they've allocated $75 billion to that. And then if you look at the kind of the multiplier and how they're getting that money into the banking channel, it's essentially going to provide upwards of $500-600 billion of loans to small businesses. So the Main Street program, businesses can have up to 15,000 employees, up to or less than $5 billion in revenue last year, and then 19,000 U.S. firms, were kind of between 500 and 15,000 employees, and that group, that cohort, employed somewhere between 30 and 40 million people out of a country that's just call it 300 million. Banks can lend up to 25 million in new loans, or refinance up to 200 million. And then basically the Fed will come in and buy that debt. So the banks are the direct lending entities, and the Fed is just buying that paper. Well, why is all that important? Why is it important for the Fed to want to jump into helping small businesses versus some of these more well-publicized bailouts of the airline industry and so on and so forth? Well, small businesses are responsible for about half of U.S. employment, half of the economy, and 40% of total business revenue. And going back to that, in the markets and talking about the difference between large and small caps, the Russell 2000 is really kind of a proxy, in my view, for small caps versus the S&P 500, which is much more of a broad kind of with an air towards a larger cap. But the Russell 2000 index, if you look at that on its own, is down 20% this year, while the S&P 500 index is down just 8%. So again, smaller companies being hurt more in the markets and in the real economy. Small businesses with fewer than 500 employees, and if you throw in franchises, they account for nearly 2/3 of the more than 20 million jobs that have been lost since March. And 43% of businesses were temporarily closed in April, and businesses had, on average, reduced payrolls by 40% relative to January. And interestingly enough, 38% that said that they were unlikely or only somewhat likely to survive the crisis. And again, we've talked about this several times, that the majority have had less than 1 month of cash on hand. So even with the $650 billion of the 2 rounds of PPP, it's supporting almost 50 million jobs in this channel. And, there's a lot of worry about getting customers back, and I think there's a growing consensus that we're not going to get back up to prior levels of the economy, where the economy was before COVID hit, until at least the first and perhaps maybe even the second quarter of 2021. So that we'll spend basically, the bulk of this year kind of trying to recover. In fact, the Congressional Budget Office for 2021 has estimated that the economy will still be $1 0.6% below the ending level of 2019. And that we'll have 9% unemployment at the end of this year. So what that's telling you is that you've got a lot of smart thinkers out there that have basically said that the conundrum that's being felt, the pain that's being felt on the small business sector and its incredible influence on the broader economy is going to prevent the economy from reattaining its pre-COVID levels until at least maybe even beginning of 2022 by some estimates. So I tend to think that once we get a vaccine or some type of clarity in that regard, which has buoyed the stock markets here lately, when we get some clarity on that, I think you're going to see, and we get people actually vaccinated, then you'll begin to see more of an upswing in activity. But it's going to be choppy until then, and we know just from history that it takes a while to have a bona fide vaccine for a virus, and so that is going to be the key linchpin on people feeling comfortable and getting out and spending more. So even though April is probably the lowest point in this recession, I do think the markets will continue to act well as long as there's strong liquidity. The economy is going to take a little while, but it's okay to have a good stock market and an economy that's kind of building itself back up. What we need to see for the benefit of the stock market is an economy that is continuing to build onto itself, even if it takes a while. We just can't afford to have any major setbacks. And so that's the real risk factor in there is China, a second wave, or something that kind of develops out of this election cycle that market perceives as entirely negative. So again, a lot of things to not feel so good about, but there are a lot of other green shoots out there. And we're going to continue to monitor the volatility in the markets, watch the breadth in the markets, and then obviously watch all of this near-term data. But we certainly welcome your thoughts, your cares, concerns, and certainly your questions. You can reach us at www.bkawealth.com. You can reach us also at our phone number, 512-522-4838, or you can reach me at eric@bkawealth.com, and we'll be back with you likely next week. For me, I'll be on vacation, but hopefully we'll be able to cobble something together to keep you all informed. Thanks for spending your time with us, and hope you have a wonderful week. Thank you very much.